Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is our Friday Insights edition. It's May 14th of 2021. Don't forget, the IRS extended the tax deadline, so taxes are due on Monday, the 17th of May. If you haven't already done so, you've got at least the weekend to make that happen. But that being said, let's get right to our Friday Insights edition. Thanks for watching. So if you follow us along here at Blanke Schein Wealth Management, my updates or my weekly Friday Insights, I've talked about this in great detail, and that's the topic of the day today is inflation. Why is that important? I don't think we can spend enough time on this, quite frankly, because this is part of what the Federal Reserve's sort of experimenting with modern monetary sort of theory, if you will, literally making it up as we go along, as they print more money than you can think of, and the dollar continues to decline. The United States economy is dealing with an inflationary surge. It's transitory. That's the word that the Federal Reserve is using, meaning temporary, according to the Federal Reserve. Well, if you watch the markets, the equity markets or the fixed income markets as measured by the 10-year Treasury over the last sort of, even year to date right now, the 10-year Treasury is really telling us something as it pushes closer to 1.72% on a 10-year Treasury. That's literally an indication of interest rates rising. Why would interest rates be rising? Well, it's also another indication of, one, the economy is taking off. There's a lot of sort of built up momentum as well as pent up demand in the economy. And therefore, it also is indicating that potentially at some point in time, maybe forecasting that the Federal Reserve might have to raise interest rates sooner than it actually wants to. Now, keep in mind, right now, if you look at the futures markets on the Federal Reserve, markets are only pricing in at 25 basis points at the end of 2022 as we look at into the future in terms of futures markets. So there's not too much terrible sort of pricing pressure or betting pressure, if you will, that interest rates will rise sooner than later. But that could all change in the next sort of 3-6 months as we play out. This last week, we just got some hot inflationary information from the Consumer Price Index to the PPI. Let's look at this. Once again, we had the most unprecedented time in basically modern economic theory. We've never shut down. The government has never shut down the economy like they just did. It's never happened in history. So we are living history right now. We are writing history books. And we're also writing the economic history books, if you will, because no one really knows how this is going to end. But there's a lot of competing forces right now. But before we went into the coronavirus, so the very beginning of, let's say, 2020, if you will, we had January, February. Markets had all-time unemployment lows, all-time highs on markets. The economy was still screaming and booming. And then March, we got the shutdown. Well, we had a good foundation to start, but the U.S. GDP at the time was $19 trillion. And then the CARES Act and all of the other sort of stimulus by swift movement by Congress, as well as the Federal Reserve, to support and create a backstop to the U.S. economy as we're going to shut down. At that time, it was just for one quarter, a couple of weeks to bend the curve, so on and so forth. Well, we all found out soon enough that it was actually the entire 2020 that everything had to shut down for obviously all the obvious reasons, medically speaking. And our main focus was the vaccine, and our main focus was tackling the coronavirus. And it looks like now going to 2021, we are well ahead of this, and markets are saying that as markets continue to grind higher and make all-time highs. So that's a wonderful thing on a go-forward basis. Now, you can't just shut down the U.S. economy like a light switch and then turn it back on. It's not how that works. There's a supply chain backlog, if you will, that we're dealing with. We're seeing shortages in chips and semiconductors for anything from automobiles to even computers, if you will. So there's a lot of supply chain issues. And again, the government had about $10 trillion plus in ways of stimulus or sort of all this aid out there. So about 50% of the GDP in the U.S. And how do we know that the consumer actually has that money in the bank? Well, the M2 money supply looks at what's in everyone's bank account. And by the Federal Reserve, they're reporting an increase and a spike as of right now, a 27% spike in the M2 money supply. What does that mean, Rob? the money's all in the banks, and the banking system's obviously very healthy, but they're not paying you or me any money on our bank. That's why we're seeing a lot of net new deposits here at Blanke Schein Wealth Management, because we're putting our clients' monies to work, because inflation is in the works. How do we know? Well, the CPI and the PPI, Consumer Price Index, right? As well as the even the April read was hot for the CPI, Consumer Price Index, at a 4.2% rate for the month of April. Now, is that temporary? Well, I don't know. I think it's here to stay. Last night, my wife and I went out to dinner, and we were shocked to find out when the waitress brought us a bill, there was a service charge of 16%. We said, no problem. We usually tip 20%. And she said, no, that doesn't go to me. I'm your server. There's also the gratuity for the server separate from the service charge. Well, what does that mean? The service charge goes for the person in the front and the dishwashers in the back. And we said, wait a minute, don't you guys all pool tips? Like, no, we don't pool tips. So if I were to give just, let's say 16% to the service charge and 16% to the server, that's a 32% versus the 20%. That's a 12% increase in just nothing more than just how corporations are sort of just passing on the additional costs, labor costs, if you will. Now, the Federal Reserve said there's not inherent pressure in the labor costs right now. I just had a real-time, relevant, real-world example of how they're passing on labor costs to the consumer. And we see everything from shrinkage in packaging. I talk about this on my kitchen table with the ice cream and the cereal for my kids. I say that they'll charge the same, but instead of 12 ounces, it'll be 11 and a half ounces. And if they do that enough times, that's how they make their numbers in a corporation and retain profitability, if you will. So keep an eye on that. That's happening all over the place. So inflation is inherent in everything that we're seeing. So what do we do here? Well, it's a great market for equity markets and anything that is a real hard asset. We're seeing commodities, right? Lumber costs are up 300%. We're seeing metals up 70%. We're seeing all the other sort of commodities-based pricing surging as a result of this. So you want to own real hard assets. That's why we're seeing equity markets, real estate, commodities, and a few others, even collectibles. That market's super, super hot. They're not wrong. They're going to stay ahead of inflation. Now, the Federal Reserve will be in the next 8 to 12 to 24 months working on this theory of modern economic policy, if you will, and literally sticking to their guns. And we're going to watch in any of this the 10-year Treasury, as I talked about that, because it's going to either get it right and let us know whether or not we hit above and break through the ceiling right now temporarily on the 1.7% 10-year Treasury. And if we do, then we can see a lot more pressure on the Federal Reserve to actually come to changing their policy stance and maybe tightening, meaning raising interest rates sooner than they would have to or wanted to. But as Milton Friedman once said, the great economist said, you're going to get inflation when you have too many dollars chasing too few goods and services. And that's economics 101. We're seeing that too many dollars, 27% spike in all of the bank deposits is your litmus test and your proof that there's so many dollars out there just waiting to get out there into the U.S. economy and start spending once again. So that's good for consumer in terms of consumers are healthy. That's good for corporations that can take advantage of that. And so earnings will translate, again, a quality environment for earnings in the S&P and all the indices going forward. We believe here at Blanke Schein Wealth Management. But in the meantime, we're going to get fits and starts with this inflation scare. That's it. So here's kickoff to the weekend. Enjoy your weekend. Thanks for watching and tuning in to Blanke Schein Wealth Management. And if you have a friend or family, please pass this along and share. We're happy to continue to educate and tell you what's going on with the markets. Take care.